As we enter the rate reduction phase in the current market cycle, we expect gradual shifts across alternatives over the next 6 to 12 months, with lower rates enhancing liquidity and cushioning the slowdown in economic activity. Markets and risk assets will remain broadly supported. Over the medium term, however, interest rates will likely stay higher than the levels at which many private deals were executed on before 2021. For existing private equity investors, we anticipate a measured recovery in transaction activity and returns. Yet, for new investors, the current landscape continues to offer an attractive range of opportunities, such as the secondary markets with more reasonable valuations. In private credit, the floating rate structure means that income for investors should trend down alongside base rates. While falling rates provide relief to borrowers, many high-yield issuers have already refinanced and extended maturities when the market opened up with more favourable rates at the start of 2024. The asset selection and management capabilities of the managers are key in this next phase of credit cycle. The real estate sector should benefit from the effect of lower rates on property valuations and improved liquidity, credit availability, etc. However, investors should also factor in structural shifts such as changes in office usage and the rise of logistics, which are exerting more influence on the outlook for certain parts of commercial real estate. Although rates are falling, non-zero inflation, high levels of government debt, demographic shifts, and an increasingly fragmented world intensify stress in traditional asset allocation frameworks. Investors need new strategies and new asset allocation for the rest of the 2020s. Alternatives assets continue to be a compelling source of returns with exposures to the wider pool of private companies, cutting-edge innovations, and real assets with resilient business models.
Even though interest rates are receding from their multi-decade highs, the work to improve long-term capital allocation is not done. We believe portfolios that include allocation in alternative assets will generate better risk-reward. Increasingly, alternative investments provide investors some of the best access into critical infrastructure, leading companies in areas like artificial intelligence and biotech, and innovative services which provide resilient business models that are uncorrelated with business cycles. Lower interest rates are mostly positive for alternatives, although we note that the improvements in performance for private equity and real estate will likely be gradual. Private credit remains an attractive and important asset class, but yields will trend lower against the backdrop of looser financial conditions. Finally, valuations across many parts of the private markets today are still attractive and present a great opportunity for investors to build a much more resilient portfolio for the rest of the decade.